All right. I think. Hello.
Hi.
I think we are live. As
Okay.
far as I can tell, I have put everything on on the platforms for anybody who is actually hearing this right now. It seems like there's also a little bit of a delay if I look on the platforms. So anybody hearing it right now, it is our first time trying to run this live across multiple platforms. So bear with us if we have a little bit of a slow start here. Um, Rachel, I'm just gonna check. Yeah, these are. For some reason, I gotta mute these on the other platforms because I'm hearing it.
Yeah, I can hear it too.
Stop that. It appears to
It
be.
doesn't, it's not showing you if anyone is joining us currently.
Well, that's a good question. I don't know. Nah, if I look, the problem is it's not going to show me on Riverside. It's showing me on the individual pages,
Mm.
which is a little bit hard to. I think when I'm realizing that I've seen some behind the scenes videos of stuff like this, and people have like many screens in front of them, and I always wondered why they had many screens in front of them. And I think like realistically, you need someone who's looking at all of those platforms to like evaluate for questions, and so I'll try and click through periodically to find out if they're but they don't come up in Riverside. So
Okay.
I don't think anyone is going to be able to like message us through here. So anyway, we'll figure it out.
Okay.
Um,
I can always check
the
too.
Yeah, right. So yeah, if if anybody who knows me is out there watching these and shoots me a text with if they see questions popping up, that would be amazing. I know Song was gonna look and see if it was working on Facebook. So let me text her and see. And okay. So anyway, I figured we could just start with a little bit of an intro for anybody who joins that doesn't know us, and this will get recorded and what I know we'll be quick because we've done this stuff before. But um, I'm Jason Balara, CEO, co-founder of Lark Capital. My background in real estate is I was in construction since I was a teenager and used that a lot on the single family side, working my way through high school, college, vet school, and beyond. I'm also a veterinary surgeon. Most people know that. And so we'll talk about kind of what our current focus is, but we've been doing a lot lately that's been very veterinary centric. So I'm sure we'll touch on that. But I'll leave it at that. We founded Lark Capital in 2020. We're a syndication and fund manager company, and I think that's fine for now. Rachel, you want to give yourself a quick introduction as well? Rachel is our investor relations specialist, and she joined the team. I was going to say recently, but I guess we're coming up on close to 6 months. So yeah, why don't you just give a little background as well?
Yeah, I'm Rachel McFarlane. As Jason said, I recently joined the team not too long ago, about 5 months ago now, and know Jason from working together in veterinary medicine. I myself have also had some single family uh, residential real estate experience from family, and am happy to join the team from a investor relations standpoint.
Yeah, we've really I don't want to say shifted, but we've decided to really focus on investor relations and investor experience, and are continuing to do so and try to make it, sort of not, both for new investors but our existing investors, and making that a priority as it should be. And so that's a big part of why Rachel's with the team. and really not on purpose that you're from the veterinary community, but that's my network. That's the people I know. Song isn't on here tonight, but she's my executive assistant, although I would say that's a understatement for what she does. Um, More like a COO, but she has, I think, tennis with one of her sons. So, but Song is also from the veterinary world. She was a doctor's assistant for a long time, and that's how I knew her previously. And she moved into residential real estate for a time, didn't love that, and then came over and joined me. So, not intentionally, but in a lot of ways, I actually think it's beneficial. We've all come from the veterinary world, and 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 subsequently, a lot of our investors and our network are from the veterinary world as well, and so we can, sort of speak to the challenges and things that they might experience in their day-to-day life with work and family and balancing it all. And so we know what that's like, and that probably extends to other busy medical professionals especially. So I think it's nice when you're getting into something like passive investing to have someone who to talk to, who you can actually relate with in terms of um, their background. I've had a number of uh, MDs on my podcast that have gotten into real estate, and we can still talk about what residency life was, and kind of all of the demands that have been on them from a career standpoint, and why real estate is then they've found it so beneficial to their own lives and well-being. Um, we Like I said, we want this to be a live Q&A. I'm unfortunately uh, probably gonna be hard to find the actual cues if anybody's posting them right now, in terms of questions, but we can go through what we had as far as pre-submitted things. I think that's probably a good place to start, and then as people trickle in, um, if they join and they post questions, we can periodically check the platforms for that. Um, do you have anything you want to start with by asking? We can go there, or I can look at some of our sort of pre-asked questions.
Well, I think just going off of where we started, which is we all kind of coincidentally came from the veterinary medical field. I think a big part of what we could initially start talking about is the social impact component that we
Sure.
do, which is unique to, I think, our profession and
Mhm.
what we're doing now. And so I think it's good to touch on that and explain that aspect of this
Yeah.
business.
Yeah. No, I think it's a great place to start. It is also Mental Health Awareness Month here in May, and so um, that relates very um, closely to what we'll talk about here. I think the as a little bit of background as to sort of why Rachel brought that up, and why it's a big focus for us is coming from the veterinary community. Mental health issues are a big challenge. It's one of the um, highest. Veterinarians and veterinary technicians have some of the highest suicide rates of all um, career paths, and so there's a number of reasons for that. I don't really think we need to get into that necessarily right now. It's not meant to be a discussion entirely on the challenges. We do a lot of that on our social media, but the point is it is a real problem, and because of that very real problem, there have been organizations that have come to light. Specifically, the one that we've partnered with is Not One More Vet. Not One More Vet is an organization that was formed strictly to be a resource for veterinarians that are struggling with mental health issues, and a place for them to go. Sadly, many of us know someone in from our career paths that has ended their life prematurely, and it's you know I do know someone I was close to, and I would have never, ever, ever expected it. So I think that there's a lot of people putting on a brave face where they may be struggling underneath. And I think that's an important thing when it comes to Mental Health Awareness Month, and knowing that there are resources out there. So for us in the veterinary community, there is Not One More Vet is an organization, and there's also Not One More Vet Tech. So they're kind of sister organizations to be support places for both. And then the community people as a whole, one of the coolest things, and I learned about this within the last year, is they the the suicide prevention hotline used to be like a long normal phone number, right? Like, I don't know what it was, but there was actually a song about it, that was made where they put the title of the song was the number, but since then the suicide prevention hotline number has changed to 988. And so I think it's a great thing because it's, in times of crisis, it's a easier number to remember. You don't have to, be sitting there having major struggles and then go look up a phone number to get help. This is, something that you can have in your mind, just like we all know 911. Um, and it is, an equally important emergency. So just to put that out there, it's our focus on that, sort of impact side of things comes from our connection to the veterinary community. We've partnered with Not One More Vet on our fund, and what that means is we are donating 25% of the fund profits to Not One More Vet. Um, and I think the question that always sort of follows that, or maybe people are thinking is, well, is that going to hurt my returns as an investor? And um, it will not. Those proceeds, the donation proceeds, are coming to Not One More Vet from the Lark Capital profits that come from this fund. So we invest alongside our investors. So those profits will be coming directly from us after investors have already been paid their returns. I don't I don't know this for sure yet because we're still early in the fund, but it may actually benefit our investors from a tax perspective, even though it's not impacting their returns. I don't know that for sure. So don't count on that, but it may be something that comes out of it as well as a sort of an added bonus. Um, the the reality for me is that even before we started this fund, I wanted to have, uh, I still want to have a charitable foundation. And I want, my podcast is called Know Your Why, the Know Your Why Real Estate Podcast, but I would like to have a charitable foundation called the Know Your Why Foundation. And I would like to be able to, you know, have our work create a impactful component outside of just you know real estate, or outside of just what we do in our day to day. And I think it's a great that we started with veterinarians, as obviously that's very close to all of us on the team, and my wife's a technician. I had like there's there's a lot of people that I know from this community, but it's also not necessarily the only cause that I'm passionate about. I know it's not the only cause that you're passionate about, Rachel, and same with Song. And so my ultimate goal and dream on this is that someday, we have the Know Your Why Foundation running always, not just in, association with a specific fund, where we are able to create an impact across multiple causes, whatever it is to what's important to us as a team. That's really my goal, and we can always decide, okay, where are we gonna put that money. And it may not always be Not One More Vet, but obviously that's a charity that's close to home, and that is specifically linked to this fund. So I don't know if you have anything to add there, but that's kind of, I would say, in a nutshell, what we're about, really down to the core, as far as fundamental principles is that we believe in as a company.
Yeah, no, I think it was a pretty in-depth explanation, and something that I think, like I said, sets us apart from other groups, other capital groups, and so and
Oh, looks like we lost you there for a second.
am I back?
Yes, you are. Yep.
Okay. Got an incoming call. Um, the that's one of the things that sets us apart, right? And so I think the biggest question that comes from that is what does that look like in terms of returns, and how does that all work? And it's interesting because um, there is that tax perspective, which, right, like may not be a factor, but it'd be an
Yeah.
interesting consideration to think about and point out to our investors moving forward, and even look into from our side of things.
Yeah. Yeah. And on the tax thing, once we know for sure, and this, the fund is relatively new. We're still the tax um, the tax returns are still in process. For 2023, and so the whether or not that is something that we can pass through to our investors remains to be seen. And if it does pass through, great. We'll be able to say it definitively. But it is something that may be, sort of like I said, that added bonus. But it's not the main focus, obviously. All right. Well, so maybe to piggyback off that, we can talk about the fund just a little bit, and
Yeah.
because that is our our main focus right now, and where we get a lot of our questions. Our fund is called the Veterinary Impact Fund, for the reasons we just talked about in terms of the charitable contribution, but also, as we mentioned, there are struggles in the veterinary community, a lot of them financial, and we want to be a resource for people as far as financial literacy and just awareness of opportunities to our veterinary network, awareness to people outside of the veterinary network as far as some of the struggles that the veterinary community face, just to create something that is more sustainable. But our fund is we're focused on multifamily real estate. We are also focused on, within the fund, purchasing small businesses, and the concept behind that is, real estate is a great vehicle to grow wealth. At the In the current state of the market, in a lot of instances, it's hard to generate the high cash flow that people are used to from, um, you know, 3, 4, 5, 6 years ago. And so what we wanted to do was, sort of continue to have multifamily real estate as the foundation of our fund, and then layer on top of that cash flowing small businesses, so that our investors can get the best of both worlds. And so that's really where that structure came from. And ultimately, the way I thought of it, I guess, is it was just what I had decided to do in my own life. So, as I said, I invested alongside all of our investors. We have other assets under management that are single syndications, so not fund structure. And even within our own deals and some of the other deals I've invested passively, some of the cash flow has slowed down. And so what I realized is generating revenue from a business, increasing business revenue, is probably a faster lever to pull than necessarily relying on, you know, interest rate changes or rental increases and stuff like that. Like, that stuff happens over time, but it's less controllable, and takes more time. So my idea was to put the two together. I thought about, because that's what I was doing in my own life. And then I kind of thought, well, I was encouraged by a mentor to think about starting a fund. And I thought, well, if I can do it the way I want to, then sure, let's offer this out to investors. So, as you know, but maybe people watching don't know, all of everything within syndications and funds is governed by the SEC. Should As it should be, for safety for investors. So I had to make sure that it was actually legal for me to structure the fund the way I wanted to. So first had a number of meetings with my SEC attorney. He said you can do it, but here, the SEC says there are specific ratios to how much of the equity can go towards real estate, how much of it can go towards businesses. So it's we don't need to get into the weeds of all of that, but the point is, structuring it this way, I think, will in the long run provide very favorable returns to our investors, and also kind of create a model that we can build off in the future. Anything that you think we should add there?
I think one of the questions that comes from that is now, knowing that, or when potential investors learn what type of assets we're purchasing or invested in, is how do we manage those?
Mhm.
What does that look like from your perspective? You're the operations piece of this. You're the active investor. So I think that would be great to explain to anybody out there listening
Yeah,
what that
yeah.
looks like.
So it's a great question, and the something to understand. I think if you want to take most people, when you say real estate's a good investment vehicle, most people are going to agree with that, right? That even if they haven't done any investing in real estate, maybe they don't know about it yet, but most people are going to agree. They've heard, that people make money, they grow wealth investing in real estate. What, but I think what people don't always know is that there's almost like an endless number of possibilities as to the way that you can get invested in real estate, and um, the way that many people think is if you're gonna go into real estate, you're gonna I gotta find a house, and I'm gonna buy that house, and I'm gonna rent it out to someone, or maybe I'm gonna flip a house, and I'm gonna go in there and do all the work myself, and then I'm gonna sell it for more money, and all of those things are fine, and all of those things are very possible. When you get into the space of syndication and purchasing large assets, large multifamily assets, now it's more like running a business, right? So we're doing everything as we as Lark Capital, we act more like the CEO, the operators of these businesses. And so if you think about, just as a comparison, you think about of a large company like Apple. I like Apple products, so it's the one that always pops into my mind. But if you think about a large company, right? We all most people might know that the CEO is Tim Cook. Tim Cook is not sitting there in the office with one person, sort of growing Apple, managing Apple. There are teams, and he's overseeing all of that. And so certainly we're nowhere near the size of Apple, but the idea is the same in that we are kind of that CEO, and the way that we manage our properties is as asset managers of our third party property management group. And so we have people in the markets that we invest in that are actually there. There's someone from our team that is on site every day. They're the kind of front facing piece to the residents, and we have meetings with them at least weekly. Generally, we talk even more than that. We have access to all of the financials at any time, so we can look over all those things as much as we want to. We don't I don't really talk to residents unless I go to the property and I walk around and I talk to the residents, and sometimes I do that, and I um, go out to see our properties on a regular basis just to be hands on. It's very much about a team. We have partners, both partners on the ownership level, and we have partners in terms of the vendors and our third party property management. So we as asset managers, we manage the managers. When it comes to the small businesses that we're going to have in the fund, it's a little bit different in that there aren't a whole lot of unless you're like a large private equity firm, there aren't a lot of business management, like third party business property management or business management services. And so for that reason, I'll be keeping the businesses that we purchase local, so that not that I'm going to go sit in all those businesses every day, but I will be able to hire my manager directly and oversee them, from a close proximity. So a little bit of a different focus there, but not not dissimilar. It's just a term of in terms of locations. Do you think that answers the question, or are there things
Yeah.
you might add to that?
Yeah, no, I think that answers it well, especially factoring in the, small businesses that we'd be
Yeah.
considering. Um, yeah.
Okay. One of the questions that came in that I think is a good one to answer is why might you invest in real estate, through syndication or funds versus the stock market? Um, and I am not against the stock market at all. I think you should invest in stocks. That's fine. I don't have a problem with that, and I also invest in stocks. We don't. Our goal is not to tell people they shouldn't invest in other things. Our goal is to teach people why they should be investing in real estate as well. And so I'll just point to some of the big differences. When you talk about investing in stocks, you have some of the pros. You have a lower barrier to entry, so you can invest in, like you can get a Robinhood app on your phone, or you can get a brokerage. You can put a couple $100s in. You can buy stocks, right? So you can be involved very very easily, and so there's a level of you know barrier to entry that's very very palatable to a lot of people. The other side to that is, it is liquid, right? So as long as it's not in a retirement account, your stocks can be bought and sold daily if you want, more than once a day. So if you're into day trading and you want to do things like that, then by all means, that's fine. People make a lot of money there. Um, and now the liquidity piece is often pointed to as, one of the upsides when it comes to stocks. I actually disagree. I think you need to have liquidity. I think that's important, but I don't know that that's a pro when it comes to investing, because people make emotional decisions, and you don't want to be making emotional decisions when you're investing. And so, you might have a day where, you hear some big news story causes some stock to drop a bunch, and so you sell off, and then you lose money. Or the best example of this to me is the whole um, GameStop debacle. They made several Netflix movies about it. Like, this was a big deal. Essentially, GameStop price was driven up by media attention, and a lot of people jumped in and kind of wanted to get in on that bandwagon, and then lost a whole bunch of money. And so the liquidity piece and the low barrier to entry can sometimes be negative, because you could, in theory, get that same Robinhood app, put as much money as you want on there, and lose it all. You buy you're essentially gambling on stocks if you don't necessarily understand what you're investing in. So with real estate, it's a higher barrier to entry, right? You're going to need to have a larger amount of money to invest in order to sort of get involved. And I think will add this in, but I think talking about, places where you might be able to access that money that you don't think you have might be something else to touch on here.
Mhm.
But the reality is that it's a little bit of a bigger barrier to entry, so much so that the SEC, like I said, is in charge of all of this, and they have created multiple layers of what is meant as protection for investors, but sometimes it makes these opportunities inaccessible to them. And so, a lot of real estate investments, you have to be an accredited investor, which is well, I'll define it. Accredited investor, most commonly they look at your salary. So if you're a single person, you need to be earning 200,000 per year, and if you're a married couple, you need to be earning 300,000 per year. That makes you accredited. The other thing is net worth, and so if your net worth is greater than $1 million, uh, and that excludes your primary residence, you're also considered accredited. There are a number of other definitions that are less commonly pointed to, and also you actually can take essentially a test and become accredited. So there are, if it's something that you want to pursue and you don't meet those other criteria yet, you definitely, it's still an option. Um, the other way is there are certain syndication opportunities that would be available to non-accredited investors. However, you have to have a pre-existing relationship with whoever that operator is. And so it's, if you're not accredited and you want to get in the game, you actually have to start, go out and find people that are doing syndications and become um, establish a relationship with them. Otherwise, you in theory should not be allowed to invest in those deals. So that's just an aside there. But basically, my point is the accessibility to these real estate opportunities is not as easy as it is stocks. I have opinions on whether that's a good thing or a bad thing. I've said them before. It doesn't really matter what I think. The SEC is not changing their their rules. If anything, they're going to make it harder for people to get it. They're going to change those accredited definitions to higher number values. Um, but at the end of the day, I understand that it is meant to be for protection. So the the reason why you might choose real estate over stocks, or more of the difference is here is um, essentially it's the personalized touch. It's the fact that if you invest with us, you'll have my phone number, you'll have Rachel's phone number, you'll be able to have regular updates on what the performance of your property or your investment is. You'll have kind of front door access to all of us, and whatever questions you might have can be answered. You're never going to get that in the stock market. And just to be clear, a REIT, real estate investment trust, it's the same thing as a stock. It's just a stock based on real estate. And so those are publicly traded. Syndications are called private placements, so they are not publicly traded. Um, and so again, a little bit of a different structure, but the reality is what we want people to understand is that real estate is a very, very smart piece of the puzzle to have, and ultimately probably a lot safer in the long term as well, with less volatility. You have
Well,
anything you would add to that? I think it's a pretty wide topic, and it's
yeah.
to me, I think the personalization is a big reason why you might consider something like a real estate syndication. But you've got to, at the end of the day, if you're going to invest, you've just got to decide what is fits with the life that you're trying to build. I think is what it comes down to.
Yeah, I think in general, when we think of real estate and versus stocks, it's one, we're taught pretty early on to diversify and try and um, look into different ways to invest. Real estate is one that's more commonly known, but also the returns have the potential to be a bit larger than your traditional stocks. So, um, you know, I think that's partly a reason that people would look into real estate. And then the other thing that I thought of when you were talking about this is reporting, and that can be something we talk or touch on later, and kind of stay more in the thick of um, stocks versus real estate. But I think reporting is I mean, you mentioned the access to us and our team, and the content and the education that they receive from being a part of this group. But we do send out reporting, and maybe touch on what that looks like, how often that comes, and what the content is.
Yeah, and we send out at a minimum monthly reports on each investment, and basically it's going to be sort of high level, like what's our the, the metrics that we're looking at, what's our occupancy at, um, what are our collections at, what are we looking at, sort of one of the big terms we'll see, pre-leased, you'll see that. And pre-leased just means how many of the vacant units have we rented out. So typically occupancy is going to be listed, and that's how many people are already moved in living in those units. And then how many pre-leases, how many residents are kind of on the way. We talk about our renovation strategy and our renovation schedule and where we at with that. We talk about kind of the financial performance of the properties. It's overall high level. I think sometimes the reports are meant to be the reports are meant to, in my mind, almost meant to offer an opportunity for people to ask questions. So here's a report, this is what's going on right now at a high level. If that triggers any questions for our investors, I would hope that they would reach out. But also, we periodically reach out to them individually, just to say hi. Do you have any questions? Any concerns? And as our portfolio continues to grow, that reporting will get more and more robust, and it's again a big part of why you're on the team now too, is so that we can make sure that we're addressing any questions, any concerns that any of our investors may have, either prior to investing or once they have invested. And that's I think the main thing is maintaining investor comfort level, because things are going to go wrong. Things go wrong. No, there's no perfect business plan. It's funny. I was interviewing. This episode hasn't come out on the podcast yet, but I was interviewing someone recently, and he said, and he's got 2 decades of experience in the business, and he's like, I have yet to see anyone's projections be correct, meaning that nobody gets the numbers exactly right ahead of time. And so a lot now, that they could be higher, which is great, but just nobody has ever gotten them exactly correct. And the point is, we make projections based on our best educated knowledge of the situation, and when things change, we have to adapt. And it's a very important piece of the puzzle, is adapting your asset management strategy for the assets you have under contract or under management, and then also adaptability of our investment strategy going forward for our investors, which is again why we structured the fund the way that we did, is to try and take that into account. Yeah. One of the questions, I think, that has come up in a couple of different forms is why would you invest in today's market? Is it a good time to invest? What do you think about these interest rates and stuff like that? And I think that the simple answer is it's always a good time to invest. What you're investing in and how that looks might change over time, but the most powerful thing you have in your arsenal in terms of investing and growing wealth over time is time. And so if you don't start investing, nothing's happening, nothing's growing. You're not building to that future. Now, investing can mean a lot of different things. In the beginning, you might not be quite ready financially to invest in a syndication or a fund or something like that. But then what you need to invest in is getting ready. You need to invest in knowledge. You need to invest in ways to, create investable capital. And I said I would touch on this, and we can put it here. But basically, a lot of times people. So one, I've talked to a lot of people that are accredited and don't know that they're accredited because they don't even know what those definitions are. And so that's a thing that if you don't know, if you're listening to this, you have that question, please reach out. You also can just Google it. It's pretty readily available information. But I'll use this example. This was probably 10 plus years ago. I didn't know what an accredited investor was. Yeah, this goes back to probably, yeah, right about 10 years ago. And one of my friends sent me an email, and he was like, "Hey, something you might be interested in." It was a oil and gas like syndication, and which is another investment vehicle. It's something I don't know anything about, and therefore I would not have invested in it. Still probably wouldn't, just because I don't understand it at all. But what I didn't realize at the time were two things. One, I didn't know it was a syndication. He didn't tell me that or explain to me what a syndication was. I also, it said for accredited investors, and I didn't know I didn't know if I was. I was. I just didn't know that, and I felt embarrassed to ask. So, first thing is, don't feel embarrassed to ask these questions. Like the worst thing you can do is not improve your financial situation because you're afraid to ask questions. Like that's just, I understand that because I've done it, but at the same time, like just get past it and ask all the questions. Ask all the questions of us, ask all the questions of anybody else. Like you should be asking questions. I talk to a lot of potential investors, and they're like, oh, I'm going to run this by my financial advisor, but they've never asked their financial advisor any questions about what they're telling them to invest in. And it's just you got to ask the questions. You got to understand. I've we don't have enough time to list off all the mistakes I have made by not asking the questions when it comes to kind of investing in the future. So ask the questions, um, and and then you know if if you're in a place where you do want to invest, and sources of that can be simply obviously savings. You have some cash in the bank, you want to get invested, it's sitting in, even if it's in a high yield savings account, it might be getting 4.5%. It's not a great return. It just barely covers inflation at this point. But other places, certainly, many people don't know this, but you are able to invest through retirement accounts. You have to create a self-directed IRA, which is where you can then invest in real estate. What you would have to do is roll over an old 401k or an old IRA from a brokerage type account to someone who to a servicing company that can manage your self-directed IRA. That's a good source of capital that most people don't know that they have. It also takes away that liquidity fear. You don't have liquidity in your retirement account no matter what you're investing in, right? You've got to wait till you're X number of years. And so if you're worried about liquidity when it comes to real estate, well, use your retirement accounts to invest in real estate because that that's not liquid anyway. So you might as well, kind of take advantage and marry those two things if that is actually a concern of yours. Um, Generally, so savings and cash in the bank and then retirement accounts are probably the two big ones. If you get into a situation where you're even more sophisticated, you want to get a little bit more savvy with your investing. Other places you could look would be to equity in your home or business, so like a home equity line of credit. You could take and invest that. Now, some people are going to be horrified by that thought, and I understand because that means you're borrowing money and paying interest on that money. But this is what the super wealthy do all the time is they make their money on borrowed money. That is actually the game. And so you could take a HELOC, home equity line of credit, or a business line of credit, and you're paying X percent. So depending on, maybe that's 5, 7%, whatever the rates are at that time. And if you could invest that in a vehicle that's making you 15%, now you're still making that spread over it. And so it's a way to make money on money that you couldn't access before. Like, it's great to have equity in your home. We all love when the value of our home goes up, but generally it doesn't do you any good. You can't buy food with that. And so unless you find a way to harness it and invest it, then it doesn't actually help you until it comes time to sell down the road. So and by the way, like, refinancing your home equity line of credit, that's not a taxable event. So you can get access to money tax free. So there are a lot of strategies, and again, it's getting into this stuff here. Probably we could spend an hour on just those topics alone. So I won't go any deeper than that. But um, the idea is, yes, it's always a good time to invest. now is a good time to invest. People, I love the saying, this is Warren Buffett, but he says, uh, you should be greedy when others are fearful and fearful when others are greedy. And so it's an interesting phenomenon to watch. Um, but when the market is hot, prices go up. But everybody wants in on that market because things are happening and they're excited but eventually that market's going to come back down, and then when the market is cooled down like it is now, people are afraid to get in. And the reality is this now is probably, you know, today might not be the bottom, it might be in 2 months, but like the reality is you're holding real estate for a long time. And so if you get in somewhere near the bottom, you're going to be in good shape because you're going to hang on to that for, 3, 5, 7, 10 years, whatever your investment vehicle is. So the interest rates are what get the headlines. And it's admittedly, the interest rates are causing some challenges in the real estate market simply because they changed so fast. It isn't so much that the rate is that high from a historic perspective. We were actually at historically low rates. That was the anomaly. When we had interest rates that were in the twos and threes, that was the anomaly. That was what people should have been like, this doesn't make any sense. But everybody wanted to take advantage of it because it was literally basically free money. If you can borrow money at 3% and make a 15, 20, 25% return, you should do that all day, right? But that's not an environment that's going to last. So the reality is now our interest rates are, somewhere between 6 and 8%, and that is actually pretty normal. Like, and interest rates have been much higher in the past. People still made money on real estate. I bought my first house. My interest rate was 11%. I refinanced that house twice in the whole time that I had. I think I had it for 5 total years. I refinanced that house twice. I got, I think, all total about $250,000 of tax-free money out of that house before I ever sold it. So the reality is that it doesn't matter what the interest rate is, right? The interest rate is one number. I'm not going to pull up a spreadsheet, an underwriting spreadsheet right now, but if anybody wants to see one, they're extremely complex, and the interest rate is one single cell on that whole thing. But that's what gets headlines. And what caused distress is that they went up so fast. And so that's where the real problem came from, is not the actual rate itself. If that had happened over 3, 4 years, which is what normally would happen, even 2 years, it would not have caused the challenges that are being faced in the market right now. It's just they shot them up so fast. Um, and disclaimer, I'm not like a economist. This is my view of what has happened, um, and also, sort of regurgitating some of the opinions from some people that are much smarter than me that I've talked to on podcasts and mentors and things like that. So it is a different time in real estate than it was 2 years ago, 3 years ago, but might actually be a better time to get in terms of what you're going to see, over the next, like I said, 3, 5, 7 years.
Yeah. I think another great thing to mention is there are a lot of questions right now, surrounding the market and what that looks like for investors or people who are even thinking about investing for a first
Yep.
time. And so going back to something you mentioned earlier is we are here to answer those questions, and it's
Yep.
if anything, take advantage of that. Like, be willing to connect and ask those questions and not be fearful of asking them, or for fear of not knowing or feeling foolish or something. I mean, if anything, it's knowledge that you can use in the future.
Yep.
Another great way to just start like understanding and learning what we do and what we offer, and just in general, um, our group and what this world of real estate syndication is about is signing up for our newsletters, which are
Yeah.
really educational and informative. And there's no harm there in getting an email that takes you 5 minutes to read and helps you understand a world that you might be interested in.
Yeah.
So
No, I completely agree. We're trying to create as many resources for people as possible that they can, that they can learn, they can get involved. But ultimately, I think sometimes too, just scheduling a call with one of us and asking the questions that you have is super important. We're Rachel, we're coming up on an hour, and I don't think that we should, go on for forever in because I hope people we can this is recording, so hopefully people will then watch it. But one thing I do want to touch on before we end, because I think it's relevant to some of the fear that is being experienced in the market, is what are some of the uh, biggest lessons I've learned and things I might do differently going forward. And so I thought that might be helpful for people to hear because it's it's not it's not all perfect. It's a every day to me is a learning lesson. And so I would say a couple things I've learned. This one I probably already knew, but it has become even more apparent. The team that you surround yourself is like 100% the most important thing, like in business and in life. Like and I say this, I mean my wife, my family, I mean my team on my veterinary business, I mean you and Song and our VAs in Lark Capital. It all of I'm referring to, the vendors that I partner with, the team and the partnerships that you form will 100% be the most important thing that carries your business forward. Uh, Whatever business, I don't care if you're talking about real estate, it doesn't matter. The people that you surround yourselves, the culture that's within that business, and this people who have W-2 jobs, this can apply to your W-2 job. If you're in a job with a toxic culture, you don't have to stay there, especially now that they did away with non-competes for those of you in the veterinary world. But you do not have to stay there. The people you surround yourself 100% are going to be the most important thing in your life. And I think the reason why this is applicable to this particular discussion is in the beginning, and I did this and I saw it with a lot of other real estate investors, new real estate investors. You just want to do deals. And so you know, you kind of have the tendency to attach yourself to whoever can make that happen. And you really need to be very selective in your partnerships because you might partner with someone like a friend. You could partner with someone you like a lot, you get along with well, but they may not be the same person that you need to partner with to run your business, do real estate deals, whatever the case it is. Like there's it you have to understand, like there are people there are people that are, friends of mine, family of mine, that I wouldn't put them in the role of, whatever, right? Like pick your piece. People have their places in your life. It doesn't mean you have to put them in the other places in your life. And so as you're, starting up a business and you're just eager to get going, you just make sure you're really clear on the partnerships that you form. This could apply to marriage. I mean, this is literally, again, like out to life in general. But just be really smart about the partnerships that you form. Two people that are the same, typically not a good business relationship. You want to have the same values, but if you have the same strengths, it's probably going to be hard. You want someone with a complementary skill set and similar values. That's really ultimately I think makes a good partner. So that's one of the things I've learned. I think, and these two things go hand in hand. The other one is don't be in a rush, right? So a lot of people were trying to do deals, trying to grow, scale. Scale was like the word that was all over social media, and I think scaling at the cost of, being I guess making as many smart decisions as you can. And so one thing I've been, and honestly, this makes my life easier, but one thing I've really focused on is slowing down. I don't necessarily care what our unit count is anymore. I don't care, assets under management and things like those are cool metrics to look at, and you do need objective measurements when it comes to business. But what I instead of looking at those numbers, I'm looking at investor success. That's the metric that I want to focus on, and those don't necessarily always go together. So I have shifted focus in that regard. That's overall what things I would sort of do differently. If you get down to the nuts and bolts of investing in real estate, I would say that the number one lesson, the most important thing, and a lot of people are learning this right now, is that the debt structure matters more than anything else. Not necessarily the interest rate. I don't care what the interest rate is. I care more that I have flexibility of exit. And so what that means is, what is the length of that loan term? And is it going to cost me money to get out of it? And so I don't want to be forced to sell, right? Because that's where people are struggling right now, is if they're in a loan term or a loan product that's forcing them to sell when the market's down. That's a bad scenario to be in. I want to be able to pick when we sell based on maximizing the value of our assets. And so that is there. We could again do a whole nother call on just loan structuring, and I am certainly not the foremost expert on that, but I have learned very much how I feel about structuring that going forward for any deals that we do, and that's why for example, the first asset we have in our fund is a large multifamily asset in Arizona. One of the most appealing things to me is that was a loan assumption. The interest rate is less than 3%. Great. I told you I don't care about interest rate. I mean, it's nice when it's low. But what I do care about is it has 7 years remaining on the term. And so 7 years is plenty of time to ride through this cycle, get into the next up cycle, and then sell when it's the right time. And so the key is, like, it, just to align it with what expectations from an investor. Like, if you get into a syndication, typically you're looking at 3, 5, 7 years hold time, somewhere in that range. Occasionally, some might be longer than that. But the the reason why it's not like we're gonna sell this on year 4 and 6 months is you want to be in control of when that happens. And I can feel fairly certain that if we had planned to sell an asset 4 years in to our hold time, and the market was bad, and we sold it for X million dollars more a year and a half later, they're not going to be sad about that. No one's going to be disappointed that we made more money because we held it a little bit longer. Like, what is going to be disappointing is, oh, we had to sell this, therefore you didn't make the money you were supposed to, or something like that. So I think the debt structure, and again, going back to the podcast episode that I'm very excited for people to hear when it comes out, but that investor had the same sentiment. He said, all I care about is flexibility of exit, basically. And so that is very important. And one of the things, another thing where this ties into the fund and bringing small businesses in, when I modeled out the returns on the fund, I modeled the average sort of hold time on the real estate of about 5 years. I did not model an exit on the businesses. I just modeled in what we expect our pre-existing cash flow to be, and carry that through. So in reality, there could be a scenario where our fund goes full cycle, we sell all the real estate. If those businesses are cash flowing and the investors have gotten all of the rest of their capital back and have achieved their returns, there's no reason we couldn't just continue to keep those businesses cash flowing. So it's but if the time is right to sell them, then we'll do that. So there's so many different options, or sorry, there's so much importance to having different options. And so that's what I have really found to be incredibly important, sort of going forward is just that sort of optionality and patience. I think is what it comes down to. It's like you sort of a lot of the promotion you would see on social media and stuff even a few years ago would be like it was all about acquisitions, like how many deals can you do, how many units can you get, and then exiting them as fast as possible and showing this great return. And you could do that in that, for that short window of time of 3 to 5 years, you could do that. But that again was the anomaly, and that is, going forward, we will definitely take this as a, truly a long-term approach. And so if it takes us, you know, a year between deals, it takes us a year between deals because that will mean they're good deals. And so that's kind of where we're at now. That's what I've learned, and things I would do differently. And I guess not that I would do differently, is that we are doing differently.
I think that's good perspective to share. As someone who, as an investor, if you know you were the person managing these funds and the operations person, I'd want to be having these conversations with you. I'd want to hear your perspective on these things. I think it's just added value and insight into who you are, and who I want to trust, who I want to be paired with, and so that's why I think, again, we just encourage you to reach out, talk, communicate, ask questions. All questions are
Yeah.
good questions.
Yeah. Yeah. Please don't hesitate to ask questions. Don't feel like you're, there really are no bad questions here. There's a lot of, I think, a lot of fear and uncertainty that some of it is warranted, but probably not nearly as much as is out there right now. And I think, um, if you want to change your life and change, your financial create financial freedom, I personally, I think real estate has to be a part of that. And I think it will, that might mean something different for every person, but I think ultimately, that is the ticket to kind of long term. Yeah. Well, I think probably a good time to wrap up. We've been at it an hour, and I want people to be able to, watch this and not fall asleep. So, we'll wrap it up. Thank you, Rachel, for being on with me, and,
Thank you
thank
for having
you
me.
to the folks who listened. Um, Please feel free also to just reach out. You can go to our website. It's larkcapital.com. You can email us directly, Jason at Lark Capital or Rachel at Lark Capital. We're on social media. I mean, however you're comfortable reaching out, we would be happy to talk, and hopefully we can provide some solutions to whatever problems you might be facing. All right, everybody, have a good rest of your day.